All right, good morning. I see people are starting to stream in now. We have a great presentation for you today. We'll get everything started off at 12. So I'm looking forward to the presentation and I appreciate everybody's patience. All right, I see people are still trying to connect, so we're going to give another minute or two before we kick things off. All right, that should be enough time, and I'll let people continue to connect while I go over the introduction. So we'll get things kicked off right now. Hello, everyone. My name is William Mucker. I am a client executive with Camaplan, and I would like to thank you all for joining us for today's webinar. Access the top cash flowing investments in today's volatile market with Mark Curry of SMK Capital Management. As a quick note, please be aware that Mark will be answering questions throughout the presentation. However, feel free to use the chat and/or Q&A function on your screen to pose your questions whenever they cross your mind. They will be saved and addressed once the presentation portion ends and the Q&A portion begins. Before we get started, we do have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of the dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information if you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction. Please do not hesitate to contact me. I will be more than happy to help. And without further ado, I'll pass the controls over to you, Mark.
Thanks, Will. Appreciate it. Okay, guys, I'm going to share my screen here. Give me 1 second. You guys see that okay?
Looks good over here.
Wonderful. Well, thank you, everybody, for joining in today's conversation. My name is Mark Curry. I'm a co-founder of SMK Capital Management. We'll start out by sharing some information on our firm, investment experience. I'm going to dive into, the topic for today, the top cash flowing asset classes that we're investing in. What makes them attractive? Why are we selecting them for investment? And we'll also talk about our unique approach to investing in these opportunities. From there, we'll also discuss how investors are participating with us to capitalize on these favorite asset classes. So let's go ahead and begin. I'll start out by saying, we believe that who you invest with is just as important, maybe not more important than what you invest in. So who are we? SMK Capital Management is a family-owned private equity real estate investment company. We've been providing our investors and clients with passive income and growth investments since 2010. We've created and managed over 65 partnerships with our investors over the years. And a brief background on us, Dr. Curry, my father, began investing in real estate in the 1970s in the US. He's a retired orthopedic surgeon. I got my start in real estate in 2005 while working in corporate America. I was a financial analyst for a number of years. I also worked in operations management, and the skills and experiences I got in the corporate world just really meshed well and transitioned well into real estate investing. There's my father and I, and we started pooling our capital as a family together really through the recession. We built a small portfolio of small single-family, small multi-family properties in a few different states. We were focusing real heavily at the time on a lot of fix and flips, heavy value add, buying a lot of distressed properties, short sales, REOs, foreclosures, all while working full time. By 2010, the bug was in me. I left corporate America and started our firm, SMK Capital Management. And for the next 7 years, our focus was as an operating partner or sponsor. We acquired and renovated and rehabbed 60 properties over the course of several years in different markets, really, again, focusing on single family and small multifamily properties and investing with SMK investors. At the same time, my family and I were really looking for diversification. We started personally investing in other asset classes with other operating partners and sponsors. We made over 20 investments in different sectors in real estate. We tried a lot of things, self-storage, mobile home parks, apartments, senior housing, student housing. We invested in some oil wells in Texas, short-term debt, you name it. But what we did is we created a pretty significant data set over that 5-year period, comparing and contrasting returns and risk and operating partners in different sectors. And we decided by 2017 to really pivot and focus predominantly on, the private equity side, where we could utilize the relationships that we had built through investing in different asset classes and sectors with these operating partners to provide us with passive private investment opportunities, really focusing on diversification, spreading our capital across asset classes, regions, and operating partners. And then in 2018, really started focusing on recession resistance. We'll talk more about that in a moment with some of our asset classes. And we define that term really as sectors and asset classes we invest in that have a high likelihood of continuing to perform and hold or maintain asset value even during economic downturns and a recession. Today, we're looking at 10 to 20 different investment opportunities a month, and we invest in about 4 to 8 a year. So roughly about 97% of the deals that we see, we pass on. We just say no for a myriad of reasons. Our investment criteria has really been fine-tuned over the last decade. We're pretty particular and picky. We're looking for deals that have something special about them. There's usually a story, something that stands out from the crowd versus our typical, what we call mediocre, down the middle kind of deal. We see a lot of those every week. Nothing wrong with them, but there's just nothing super unique about them, so we tend to pass on them. Some of the investment criteria I'll share with you today, we really like to find opportunities where we can provide our investors with 3 to 7% cash flow starting in year one. That just helps reduce risk, right? You're investing in a property that's already providing positive income in case something happens in the first year of investment with the market, the economy, et cetera. You'll have a little bit more downside protection there. We want that to be growing. We want average cash on cash, usually 7 to 12% net to investors while we're holding an investment, and we do distributions quarterly. And an average annual ROI, 13 to 20% is our sweet spot. That includes the sale and the exit of the property, and really looking for an equity multiple in the range of 1.5 to 2.5x. Okay. Here, we're summarizing the syndicated real estate investments that we've invested in with other operating partners that have gone full cycle. You'll see that our average internal rate of return to these investments is 23%. So we're really pleased with our track record on these types of investments. Now let's dive into the details of what we call our favorite asset classes. And you can see here we focus on self-storage, mobile homes, apartments, ATMs, private real estate debt, and triple net industrial. I'm sure many of you are familiar with a lot of these asset classes. Some of them may be new. So we're going to go through and share some of the unique attributes of each, why we have and why we continue to target these sectors for investment today. Let's start with self-storage. A big one for us, you have long-term tenants, much longer than most people think, and consistently high demand for storage. The cost, if you think about it, on average is around $74 for a 5x10 climate-controlled unit. And the average tenant stays 14 months, where you have 46% of users staying, 1 to even 10 years. If you think about it, the switching costs, right? If you want to move your stuff out of storage, it's kind of an aggravated process where you have to get a truck, you have to go to the storage facility, empty it out, and then take it. A lot of people tend to just stay and pay. As of 2023, over 10% of Americans rent a storage unit, so the market is massive. Now, one thing that makes it unique from other real estate sectors, you have short-term leases. These contracts are month to month, and that allows flexibility. You can adjust rents to the market. You can increase them within 30 days notice, which is an attractive benefit, especially in the last few years of inflation. And you do often see rental increases available between 6 to 12%. It's not uncommon if you think about the dollar figure of taking, a $70, $80 unit and raising it 10%. A lot of people aren't going to move out for a $7 to $8 increase per month. Historically, self-storage has been one of the lowest delinquency rates of all real estate sectors. And there's a track record here. This is one of the reasons we got into self-storage 12 years ago. We could see some data that showed how it performed through the recession, 2008 and 2009. And it's consistently outperformed other real estate sectors for decades now. And that's a lot of times due to, we see an increase in demand for storage during economic downturns. This is common because you have a lot of folks that change something with their lifestyle. They might downsize, they might move in with family, relocate, move into an apartment, and that increases the demand for storage. we saw that REITs in 2008 provided a positive 5.1% return, while at the same time, other REITs were posting a 38% loss, and that's self-storage REITs with a 5% positive return. So you can see the variance there during, of course, the great financial crisis. It has been, and we'll show a chart here in a minute, one of the top performing asset classes through COVID. And another aspect we like, and we'll repeat this with some other asset classes too, is low overhead. You have operating expenses quite low compared to other real estate, especially housing. And that allows us to also be a little bit more immune to inflationary effects on utility prices. But we've seen utility prices on other asset classes skyrocket. And if you think about the fact that you're looking at essentially a roof and some walls and a garage door, you don't have your plumbing, you don't have gas, electricity, et cetera. There's low effect on utility price increases. So we typically see operating expenses, in the 30 to 40% range for self-storage. Provides a good cushion, provides positive cash flow when your expenses are low. And if you want to compare that to, a single family home, for example, that you're going to rent, you're typically seeing operating expenses north of 70, 80% on a home. So much different story here when it comes to the low overhead business model. You do often have easy maintenance, minimal staff. 2 folks can manage 1,000-unit property. And a lot of properties these days, and predominantly in urban infill areas, are automated, fully automated. So there are actually no staff on site. Okay, let's shift gears. I want to talk about one of our other favorite asset classes, mobile home parks. We've been personally investing in mobile home parks since 2012. Again, seeing data through the recession, we got interested in the asset class back then, just continuing to perform. But mobile homes, they come with many negative stigmas. A lot of people believe that they're undesirable places to live. And, while that's true, there are some mobile home parks that I would discourage you from investing in and living in. There's also plenty of nice, attractive communities out there. I got a couple pictures here. These are a few mobile home parks that we're invested in. You can see a little bit of the curb appeal, the quality of these neighborhoods and homes. And what many people don't know is that some of the most successful folks in the world have been investing in mobile homes for decades, and for good reason. Clayton Homes, if you haven't heard of it, is the US's largest manufacturer of mobile homes. They've been building homes since the 50s. And they were acquired by Berkshire Hathaway, Warren Buffett's firm, for $1.7 billion. And that was in 2003. So 21 years ago, Warren Buffett got involved in the mobile home park space. And you may not know this, but Sam Zell, late billionaire, his company Equity Lifestyle Properties is one of the largest owner of mobile home lots in the US. And he was a few years ago quoted saying, "I don't know of any stock or any company that I'm involved with that has a better prospect than Equity Lifestyle." And you can see the performance of ELS, Equity Lifestyle. It's on the New York Stock Exchange. Going back to 1998, this chart is showing us net operating income growth through varying market cycles. It's really telling. And what you'll see in blue is Equity Lifestyle Properties has remained positive on net operating income growth going back through 3 different downturns. The first here is the dot-com bubble. The second is Great Recession. And the third is through COVID. So really showing you the resilience of this asset class during recessionary periods. Let's talk about some of the features of mobile homes. Why do we invest in them? There's some of the unique characteristics. The business model is quite unique. What we're usually focusing on is mobile home parks where the land that we own is rented essentially to the tenants, and they own the homes. And so they pay lot rent anywhere from $300 to roughly $500 a month for their home to be placed in the community. What this does is it results in a pride of ownership where you have communities where there's homeowners, and It also reduces lower maintenance costs for us, the park owners, because as a homeowner, you're responsible to pay for your home expenses. That includes repairs, maintenance, utilities, you name it. And that reduces the expenses for us as the community owners. Again, you see low expense ratios, very similar to self-storage. 30 to 40% is quite common, generating more free cash flow and higher profit margins. And you do have a very high resident retention. People stay in communities for a very long time, as long as you take good care of them and you take good care of the community. There's not a lot of other affordable options out there, and the cost of moving a mobile home is quite prohibitive, anywhere from $5,000 to $10,000 to move the home. And so you find that 90% of mobile homes are never actually moved. Now, an important point I want to make here, this is a thesis and a bit of data that we track regularly that comes back to different asset classes that we invest in. And I'll just start out by saying, the US is in a housing shortage in many markets across the country. This has been going on for quite some time, many years. There's a lot of publications out there talking about the shortage of housing in the US, but it's even more severe on the affordable housing sector. And I'll give you a stat here, but from 2010 to 2020, roughly 45 to 50% of Americans could afford to buy a home. This dropped in half as of 2022. About 25% of folks could afford to buy a home. And I think that's really only gotten worse with the increase in interest rates and borrowing costs. And so we have a severe affordable housing shortage and significant demand throughout the country. This was one of the main reasons we invest in mobile home parks. We also invest in tax-exempt apartments, which provide affordable housing options for folks. We'll talk more about those in a little bit. But we have a user base of roughly 20 million people in the US living in mobile homes. And as I mentioned, they're one of the most affordable housing options. You can buy used homes for $10,000 and then up to even $150,000. This home you see on the screen here was about $60,000. That's in Phoenix, Arizona. And so really not much to compare with when you think about the cost here. We're finding a lot more retirees over the last few years are choosing to downsize and move into mobile homes. And for mobile home park owners, the lot rents are stable. They're predictable. They continue to grow even through recessionary periods. Another unique characteristic, this is something we don't really see in other real estate asset classes, is the limited supply. And the way I explain it to folks is the supply of mobile homes is essentially, or mobile home parks, excuse me, is flat or declining. Most of the quality locations that are near towns and municipalities that are still affordable were built and developed in the 60s and 70s. It's very difficult today to go out and create a new mobile home park community. The reason why is there's a cost prohibitive on cost, but also zoning restrictions. The NIMBYism, not in my backyard. A lot of municipalities don't want them, and that really helps moat this asset class from new supply, which is a very significant benefit to invest in this asset class. You have flat or declining supply and increasing demand. There's very favorable tax benefits for investors. We have accelerated depreciation on the land improvements, can accelerate that at a 15-year schedule versus the typical 27.5-year with residential real estate. And so what that does, most of our mobile home investments provide us with large passive losses in the first few years, even though they're providing passive income. The taxes are reported as a passive loss due to a lot of depreciation benefits here. Lastly, a very inefficient market, similarly to self-storage. It's changed over the last 5 years or so, but you have a lot of mom and pop owners. These are folks that aren't managing with institutional quality management, a lot of times not using software, not marketing online. There's a lot of low-hanging fruit. And they a lot of times manage to occupancy, not revenue. So they think, oh, the park, the community is 90-95% occupied. We're doing well. But when you dig in, you might find that the rents are 30-40% below market. That provides a lot of upside potential where we can improve the properties and communities and grow the value. Another value add measure we love to see in the mobile home space, we like to take communities that are maybe 70% occupied. And over the first few years, we'll infill the 30% vacant lots with new and used homes and sell those off. Really helps grow the net operating income significantly when you can infill vacant lots with new or used homes. Okay, shift gears. Let's talk about another one of our favorite asset classes here, industrial. And then within industrial, we like the sale leaseback space. This is essentially an industrial facility where it's being occupied a lot of times by the owner of the real estate. This is a company, a lot of manufacturing businesses. They will sell the real estate that they're occupying and then lease it back as the tenant. And what that does for us is it provides us with 100% occupancy right after acquisition. And a lot of these companies are, manufacturing businesses that are being acquired by private equity groups. And the private equity groups, they don't want the real estate. They want to inject capital back into the business and help it grow. And that's where you create a win-win between the buyer and the seller. Now, you also put in place on these properties, new long-term triple net leases, and these lease durations are usually 10 to 20 years. And so the tenants that are there to stay. You also have, with this structure, predictable increasing income, which is a very positive effect for us as investors. This sector is also a great hedge against inflation and stagflation. The triple net lease structure, it shields us as property owners from inflationary increases in property level expenses. If you think about taxes and insurance and utilities and maintenance, the tenant is responsible for all those expenses. So as the owner of this property, our expense line item is essentially zero. And we have built-in rent escalations each year. That's typically between 2 and 3%. So the rents are going up annually. That provides us predictable net operating income growth while our expenses are zero. Okay, let's talk about how these sectors have done through COVID, obviously the most recent market shock. And you'll see here through 2020, this is the height of COVID. This data came out in January of 2021 and is looking for the previous 12 months. Mobile home parks experienced rapid valuation growth. They were number one across all sectors here. And industrial and self-storage were second and third. And if we fast forward, let's go to December of 2021, you'll see that the same three asset classes remained the fastest appreciating asset classes amongst all listed here. And even from pre-COVID levels, they were just up significantly, 66% for self-storage, 34% for manufactured housing, which is mobile homes, and 53% for industrial. Let's move forward, guys. We're going to talk about fixed income investments now. What are these? Why do we invest in them? Fixed income investments provide us with predictable cash flow. They don't have upside. There isn't growth. We essentially invest in a vehicle, a fund, you name it. We'll give some examples here. They provide us consistent income, but there isn't any growth. There isn't a huge upside at the time of sale. So we do this because we can gain peace of mind during volatile markets with fixed income investments, again, providing us with predictable streams of cash flow. Now, we like to add fixed income investments to a portfolio. A small portion of the portfolio is allocated to this. We find that this can stabilize investment cash flows and improve portfolio performance. Now, one of the ways we do this, we invest in debt. This is a lower risk investment. Where we are the bank, we're lending capital to real estate development companies through construction loans and bridge loans. These loans are typically shorter term, 2 to 3 years. It's a development project. A lot of them are institutional quality, large scale commercial real estate development projects. And we see projected annual returns and started earning them just recently in our fund, which we'll share shortly, of over 8% starting in the first year. Next, fixed income investment I'm going to share with you is a unique one. Many of you probably haven't seen or heard or thought of investing in ATM machines, but we do. We've been investing in them for 5 years. We do it for the high cash flow. You're investing in a piece of equipment. They provide income through withdrawals, and we're seeing 21 to 23% cash flow beginning in year one. Now, these investments, there's no growth in ATMs, right? ATMs are machines. They actually depreciate. And so you have to keep that in mind when investing in them, but they provide very attractive tax advantages through bonus depreciation. This provides us with significant passive losses in year one. So it's another part of our strategy to earn passive losses through a lot of our investments. Let's dive in a little bit more about ATMs. It's a unique niche asset class. And I'll just tell you, how did we get into this space in the first place? So in 2010, I was at a real estate seminar and I met an individual, very savvy investor. He had been investing in, I think at the time he was in over 50 different passive real estate investments. And I asked him point blank, like, what's the highest cash flowing investment you've ever been a part of? And he didn't blink an eye. He said ATMs. And I just paused for a minute. I said, what is he talking about? Is that some kind of real estate asset class I hadn't heard of? And sure enough, he was talking about the money machines, right? And so in 2019, we started investing in ATMs. It always stuck with me that this is such a niche asset class. We found what we think to be a lower risk operating partner and investment strategy to get into the asset class. And we've been investing in ATMs since. And they've been providing us, again, with 21 to 23% cash flow each year, beginning in year one. Now, the way we do it, we focus on diversified funds of ATMs. A lot of them have thousands of machines across the country, so you're not susceptible to some machines getting damaged or going offline. And we work with one of the top 5 largest ATM operators and managers in the country. They have over 25,000 machines across the US. And ATM performance has been right on target. We haven't experienced any disruption in the cash flows, even through COVID. And the main demographic, who's using ATM? So I personally don't go to the ATM that often. My wife rarely as well. We always like to have cash on us for tipping, for the farmer's market only takes cash. Our neighbor next door's son mows our lawn. We pay him in cash. So there's this need for us personally in our home to have money in our pocket, but we're not using it. We're not the typical demographic. And if you're listening to this, you probably aren't either. So who uses ATMs? It's really the underbanked and unbanked to the US. These are folks that lack credit. They don't have credit cards a lot of times. A lot of them also may just distrust the banking system and choose to live through ATMs. And that's roughly 10 to 20 million people that are unbanked or underbanked through the US. Now, the ATMs that we focus on are in high foot traffic locations. These are essential businesses such as Walgreens, Walmart, Sam's Club, Exxon, Sunoco, Texaco, delis, different types of quickie marts throughout the US. Now, many of you might be thinking, as I have for many years, why would we invest in a dying technology, right? Let's look at that. And here we're sharing a bit of information. In February of 2021, the Brinks CEO, if you're not familiar with Brinks, they are the vaulted armor vehicles that manage and distribute cash all across the US to banks and ATMs. They actually they have access to lots of data on cash use in the US. And they came out in 2021 basically saying cash usage in the US is up. And they were quoted saying the strength of cash is just as strong as it was before. They're also citing here Federal Reserve data that cash circulation was up 16% year over year. And you can see that here in this chart. This is US currency in circulation from 2010 to 2022, and it keeps going up each year. We also see that the increase in US currency circulation was up 54% from 2016 to 2022. So maybe contrary to what a lot of people think, still a lot of cash use in the US. As of 2022, roughly 6 out of 10 Americans said in a typical week, at least some of their purchases are paid for using cash, and they always try to have cash on hand. That's 58 out of 100 US adults. And then at the bottom here, you can see for the 50 plus age group, that went up. 71 out of 100 folks said that they try to make sure they always have cash on hand. In addition, if you look at the share of payment instruments being used, this is based on household income. So the lower household incomes use cash a lot more, and the higher household incomes use cash a lot less, doing credit cards as the predominant choice. But what you also might find interesting is in red, these are the mobile payment apps, and you can see that they are still the lowest percent, or one of the lowest percent of payment instruments being used across the US. Okay, let's shift gears, guys. Before we get into our asset classes and a fund, I'm going to pause and see if there are any questions that we want to take at this point. Will, maybe you could let me know if any questions have came in.
Yeah, absolutely. At the moment, no questions have been posed, but like Mark said, I highly recommend using the Q&A function or chat section. Post your questions now for Mark.
Sure. Thanks, Will. And if anything comes in, just let me know. Obviously, we'll spend some time at the end going through questions, but I'll keep going in the meantime. You know, we have a unique approach to investing in these opportunities. While we do invest in these assets individually, we also combine them all into a highly diversified fund that you just cannot find anywhere else. This is a custom fund that we build. We typically do one of these a year. And I'm going to dive into how we do it and some of the assets in our current fund. So I want to introduce you to SMK Alternative Income Fund 3. This is a fund that we opened in early 2023 that is currently available for investment. Now, this is a unique opportunity for accredited investors to invest into a highly diversified, lower risk fund consisting of all the cash flowing recession resistant assets that we've discussed, in addition to some apartments, which we'll cover in a few minutes here. And what we've done, we've spent the past 12 months or so building the fund. Our goal has remained consistent throughout this period. We really want to reduce risk through cautious alternative investment selection and by spreading capital across multiple deals, regions, and operating partners. Now, we've analyzed hundreds of investment opportunities during this period of time. We've only invested in a handful that we feel have an exceptional advantage. And so our unique approach here allows investors to access all of these investments in one offering. And we've invested in self-storage, mobile homes, industrial properties, ATMs, apartments, and private real estate debt. Now, within this sector, you know, we really like to structure these funds where we can provide investors with an attractive blended return of fixed income investments and those that provide income and growth. Now, from the onset of our fund, we've allocated a very strategic allocation between fixed income and growth, where we're keeping 27% of the portfolio invested in the fixed income investments that we've reviewed, and the remaining 73% or so in the investments that provide income and growth. We to date have invested in over 30 properties. You can see the breakdown here, in addition to over 5,000 ATMs and private real estate debt fund with over 50 loans in it. This allocation allows us to earn strong cash flow, beating inflation, while also providing potential upside growth and greatly reducing risk through the highly diversified fund that we've created. So let's talk about the assets in the fund. I want to start with the fixed income assets. We'll start with our private debt fund that we've invested in. Again, this is an investment where we are essentially the bank. It's a debt investment with first position liens, so a lower risk investment. And our capital is part of a large portfolio, currently includes over 52 individual loans, totaling over 1.9 billion. The capital is being lent to multifamily development projects, as we discussed. And our operating partners here have just a phenomenal track record. They've had 200 loans paid off, totaling over 4 billion, with zero losses. Something to be very proud of course. And this investment has been providing investors with quarterly returns of 8% or more since 2015. Next, fixed income investment, you probably guessed it, ATMs is a portion of our portfolio in our fund here. Again, we invest in ATMs for the high cash flow. They're providing us with 22 to 23% beginning in year one. The depreciation is a big benefit where we get significant passive losses in year one. These investments provide us with consistent annual income, limited variability of returns, and just steady Eddie cash flow. Let's move forward. We're going to share with you the income and growth generating investments that we've invested through our fund. The first is the triple net industrial sale leaseback portfolio. Again, this is the asset class where a company, typically a manufacturing business, is selling the real estate that they occupy and then leasing it back as the tenant. We have 100% occupancy at acquisition, reducing risk. It's a great hedge against inflation and stagflation. We have longer term, typically 20-year leases, built-in rent escalations of 2 to 3% annually. And the portfolio we've invested in has already included 14 properties. This is important for us because you have a lot of diversification even within this segment of industrial. One thing I want to share, I'm going to share this across most of our real estate investments with you, is the borrowing cost on these properties versus the going in cap rate. We have a very healthy spread, which is very hard to find in today's market, where the borrowing cost is what we think to be significantly below the going in cap rate. This positive spread provides us with a lot more margin, a lot more cash flow beginning year one, a lot more safety. Again, very difficult to find today with where interest rates are, but you see here that the fixed rate debt on these properties is anywhere from 3.9 to 6.5% interest rate, while the going in cap rate has been 7.5 to 8.1%. Now, this investment has been providing investors with quarterly distributions of 7 to 9% throughout 2023. A 15 to 17% IRR is the projected rate of return and a 2x equity multiple. Next, income and growth investment is into a mobile home park and self-storage portfolio that we are invested in. This is with a repeat operating partner we continue to have great success with. We talked about the recessionary features, recession-resistant features of these asset classes being, very lowly correlated to the economy. Now, the portfolio we've invested in currently has 7 self-storage properties in 6 states, so some pretty nice diversification there. Over 2,000 units. We also have 2 mobile home communities with 360 lots. One thing that makes this special, our operating partners have a full-time acquisitions team that just cold calls mobile home park and self-storage owners, all day long. They've been doing that for over a decade. And they're really targeting mom and pop owners that are mismanaging their properties, where there could be a lot of upside potential and a shorter duration by bringing in professional management, software, and different systems and processes to the property to enhance value and grow operating income. The projected level returns on this investment, we've already started getting 4 to 5% cash flow, and we're projected to earn 20 to 25% IRR and 2 to 3x equity multiple. Okay, the fifth investment we made, also another income and growth investment. This is into a mobile home park portfolio. 4 parks, 91% occupied, 233 lots in the Kansas City metro region. These are some photos of the actual communities that I took just 2 months ago while visiting this portfolio. Again, we have a very healthy spread here between the going in cap rate and the borrowing cost. The 5-year fixed rate debt is at 6.95%, while the going in cap rates were 7.4 to 11.1% for these 4 properties. So really healthy spread there, hard to find. Now, this portfolio was previously in escrow at the end of 2022 for a 35% higher purchase price. So we're really pleased with the basis on this one. Now, rents have already been raised in Q4. I think they went from $375 to $425 across the portfolio. And our investor level projections here are 3% cash flow in year 1, increasing to 9% in year 2, 15 to 16% IRR, and a 2.7x equity multiple. Okay, let's keep going. We haven't talked about apartments, and I wanted to kind of leave these for the last because most people are familiar with apartment investing. But within apartments, we have a very specific sector that we like to focus on. These are tax-exempt apartments that are exempt from paying property taxes. And I'll just share with you some information here. This is a 2-property apartment community in Houston, Texas that we invested in through our fund. They're next door to one another. It's 532 units. They're about 10 minutes from NASA. And the properties were built in 2008, so relatively newer vintage. They're 94 and 96% occupied. And they're the only 2 properties within a few miles that have not been renovated. So there is a nice value add play here where we can inject capital into the asset, renovate the units, the exterior grounds, and enhance the curb appeal and increase the rents. Now, as far as the tax abatement goes, the way this works is a partnership between our operating partners and the local municipality, where 50% of the units at the property are kept income and rent restricted. That means that they are essentially held affordable, so other folks can live there. The other 50% of the units at the property are kept at market rate. And for doing this, we get a 100% property tax abatement. And that abatement is good for 99 years, and it's transferable to the next buyer. Now, this saves us in year 1 over $1 million in real estate property taxes. And that's pretty significant, especially in Texas. Property taxes are quite high. But you can see the purchase price here was a little over $80 million. And once the tax exemption was put in place while in escrow, the appraised value was over $113 million. So we have a lot of inherent valuation growth at the onset of the investment, which really helps reduce risk as a result of this property tax exemption. Now, again, the healthy spread that we like to see between the going in cap rate and the fixed interest rate. Here we've got about 150 basis points between the cap rate and the 10-year fixed interest rate. The investor level projections of returns on this, we already got our first distribution at 7%, and now we're earning projected to earn 15 to 17% IRR and a 2.5 equity multiple. Okay, last investment in our fund, guys. This is another apartment. This one is in San Bernardino, California. Now, we don't typically invest in California. It usually doesn't meet our investment criteria. So why'd we invest in this one? Essentially, our operating partners, they already own the asset next door. So they have a bit of inside information, as we like to call it. They know the demand for the property next door. And they also know that garages are in very high demand next door, where they're sold out. They're charging $150 a month for garages there, and there's a waiting list. Now, this property doesn't have any garages. And so the business plan, part of it is to build 88 garages and rent them out for $150 a month. This additional income is projected to increase the property value by over $3 million. That's based around a 5 or 5.25 cap rate. And so this kind of unique strategy, insider information, these are the kinds of stories that we like to see when selecting deals that makes risk lower and, of course, attractive returns. There's some other value add measures here as well. They're going to build a few ADUs and they're going to bring rents up to market as well. They're currently below market. A few more things that made this unique. Our operating partners are signing personal guarantees on the debt. And most importantly, they've actually personally guaranteed the full return of our invested capital. That is rare, hard to find, and then just a good sign of the conviction that they have around this business plan. Our investor level projections are 8% cash flow in year one. We actually just got our first distribution in Q4, and it was at 8%. 22% average annual ROI, 1.4 equity multiple over a shorter term 2-year hold. Okay, let's quickly review the projected returns for our fund and the structure. We have 3 class shares, A, B, and C. You can see the minimum investments here from Class A of 500K, Class B 250K, and Class C 50K. And the fund is structured with a very simple cash flow and profit split, which you can see in the second line, ranging from 80% of cash flow and profits going to Class C investors up to 90% to Class A. And then SMK, the investment manager, earns the difference of 10 to 20%. You can see the average weighted cash on cash of 7 to 10%. We do distributions quarterly, and we'll talk a bit more in a minute here about how the fund is tracking so far. Equity multiple 1.55 to 1.7x, and a weighted average annual ROI of 11 to 16%. Now, we don't have any hurdles. We don't cap investors' upside. And so a very advantageous structure here that incentivizes us to find the best deals and put them together in this fund. We have a one-time, annual asset management fee is 1% of equity invested, and in one-time acquisition disposition fee of the same. The investment duration is projected to be 5 years, with return of capital to begin in years 2 through 4. Again, we do distributions quarterly. You can see the projected annual cash flows here. Year 1, 4 to 7%. We did our first distribution in Q4. That was net to investors was 4.3 to 5.9%. So very happy about that. And we actually made some more investments in Q4 that have not yet started earning distributions. So we anticipate that that will go up in coming quarters. My contact info is on the screen here, guys. Happy to reach out and connect with you guys and answer any questions. You can also go to our website at smkcap.com to log in and learn more about this investment. And with that, I think I'll pause here and see what questions we have.
Yeah, great presentation, Mark. Thank you for all that great information. Like Mark said, now's the time to ask questions if you want them answered live. I'm sure a lot of people will be watching this recording as well. So Mark just went over his contact information. If you have any questions and you weren't able to attend live, definitely reach out to him. Or if you have any questions about how it applies to self-direction or self-direction in general, just feel free to use the contact information presented at the beginning of the presentation to reach out to us. We're always happy to help. So again, if we'll give another minute or two for people who have questions or want to kick things off while we have Mark here. I mean, I'll kick things off while people are typing. But just to get a question in before the end of the presentation, what has your experience been with working with self-directed investors or IRA investors?
Yeah, absolutely. I mean, we've been working with self-directed investors for really since inception of our company, Will. I personally have a self-directed IRA. My brothers do, my folks do. We use them all the time. We find them to be great vehicles to get access to different investment types and obviously defer taxes, right? And that's one of the big names of the game for what we like to do. So we welcome that and happy to help folks that they're planning to invest through a self-directed IRA.
Great. Thank you for that answer. We do have a question that came in while you were answering that. Somebody in the audience asks, any opportunities for non-accredited investors through SMK?
Yeah, good question. We do see them sometimes. We are seeing a lot of the asset classes and, kind of the larger institutional quality deals that we focus on, focusing more on accredited investors. And so although it's not a no, it's just not as frequent as maybe we'd hope, where we are able to access deals that would allow non-accredited investors.
Okay, great. Thank you for the question and thank you for the answer. Um, Other than reaching out to you and on the website, what kind of information would you recommend somebody who's just getting into these sort of asset classes like mobile home parks or ATM machines? Is there any other research they can do on their own?
Yeah, I mean, there's a lot of information, of course, on the web, guys, and as you read through things and learn more, I'll say this: experience is critical, right? None of this is easy to do well and consistently. And so for us, when we're looking at the who of what to invest in, the operating partners, the sponsors that we partner with on these deals, we're looking for folks that are veterans in their trade. For example, I think I told you the ATM operating partner, they're one of the largest ATM owners in the country. They have a full-time acquisitions team. They have a full-time ATM fund management team. They just eat, breathe, and sleep ATMs all day long. And so similarly with, tax exempt apartments, our operating partner there, they have over 20,000 apartments under management. They've been investing in, these types of apartments for over a decade, and they have a very strong track record in doing it. And so there's a lot of smaller mom and pop operators out there. And while that's great to learn and go forward with, you also want to probably be picky if you can and choose to work with groups and learn from folks that are really well seasoned and the best pedigree in the business.
Thank you for that. I know that we only touched the tip of the iceberg here, Mark, and I know you have a lot more knowledge that you can provide. So if anybody who was not able to ask their question today or think of something later, maybe watching the recording, I highly recommend reaching out to Mark to get those questions answered. And one more time, I'd like to thank you, Mark, for giving us some of your time today and teaching us a little bit more about the investments you guys work with.
My pleasure, Will. Yeah, happy to be here. And again, if anybody wants to chat, discuss more, just let me know.
All right. Thank you. And thank you, everybody watching this in the future and who have attended live. And I hope everybody has a great rest of their day. Thank you.